tech stocks are down, crypto is down, bonds are down, and the S&P 500 is down. And on today's show, I'm going to identify 4 questions that need to be answered before we really step into this really volatile market. And we'll talk about very specific things that I am going to buy. And in fact, I'll give you a specific ETF that I bought today that is setting up rather nicely. First thing that we need to do is take a step back, take the 50,000 square foot view of our life, and understand that our situation, while we might be going through some financial troubles, some of you might be seeing the value of your Robinhood account or your portfolio or any kind of retirement account that you have start to be decimated from a value perspective. Understand that maybe your life is maybe a little bit better than certainly the rest of the world. If that allows you to have some comfort in your life, well, obviously that is something to think about. It could be a heck of a lot worse to drive a Porsche and deliver pizza. Now, the other thing to understand is, hey, look, if you're young, you've got a lot of skills. Over the next decade or so is going to be one of the greatest times of your life to make lots and lots of money. I certainly am an example of that from my experience. Now, I tweeted this out actually on June 3rd. This was, about 10 days ago. And the sell-off in these markets, quite frankly, I think has been rather orderly. Initially, you had kind of the ARK stock sell-off. You've had crypto sell-off. You had bonds. You've had FANG stocks. And now some of the questions that we're going to be talking about on today's show is the housing market and the job market next to fall. Is that the next hammer to fall? Because we see here's ARKK. This is essentially unprofitable tech minus Tesla. As we know, Tesla is profitable. They're almost debt-free, I believe. Creates a significant amount of cash flow in their business as well. Looks like they have a fair backlog of business as well. Other than that, though, what Cathie Wood invests in the Ark Innovation Fund is all unprofitable tech, both from a GAAP basis and a non-GAAP basis. And we see that those stocks peaked out over a year ago. We're almost looking at 18 months of declines in speculative tech stocks, which peaked back in February of 2021. Now, what was next to drop was Bitcoin and cryptocurrencies in general. I've got a chart of Bitcoin up here that peaked in value back in November of 2021. And then obviously today it sold off by over 10%. So it obviously has some people saying, well, crypto's out and the bubble is burst and the gains are over. I would argue, no, we're not going to recommend on today's show getting into crypto, but certainly videos down into the future will certainly look at crypto, certainly Bitcoin and Ethereum more specifically, because look, we did not recommend getting into crypto when everybody was talking about it going to $100,000. As people start talking about it going to zero, that quite frankly is the time you want to start looking into buying some of this stuff. Now, TLT, this is the 20-year treasury bond. This peaked in value back in December of 2021. Look at your bond fund. Went from $152 per share all the way down to $110. So while the losses in something like that don't necessarily mirror crypto's losses and certainly the Ark Innovation Fund, people put their money into 20-year treasuries because they believe that money is safe, and you've seen a deterioration of bond prices over the last several months. And obviously the S&P 500 peaked out right around bonds peaked out back in January, December of 2021 and 2022. And we've seen the S&P 500 just continue to slide down. So the question number one actually that comes to my mind is, look, we have all these declining asset prices. When is this going to impact the job market? Will we have an employment or an unemployment crisis here in the United States? And there is some correlation. I think it makes a lot of sense. Most of this is essentially cause and effect. This blue line is essentially the unemployment rate here in the United States. The orange line is the S&P 500 value. And you do see that when unemployment goes up, the S&P 500 obviously comes down. We saw that drastically back here in 2020. You also see back here during kind of the tech stock boom, you had unemployment start to tick up, and obviously the S&P 500 sold off as well. You had a decade-long stretch where unemployment just consistently went down, and over that same time, stocks basically reacted in the inverse fashion. So obviously, we're still seeing unemployment is way down here. It's at historic lows. If this starts to move up, we'd actually expect markets to continue to go down. So the answer to my first question is, I still think we have an employment crisis looming here in the United States. Employment tends to be a lagging indicator, and I personally don't think unemployment going to levels that maybe we haven't seen in over a decade, I don't necessarily think that's priced into the current market at today's rates. Now, we are starting to see anecdotal evidence of layoffs in the technology startups. So this would mirror the same thing that we saw with equity prices and asset prices selling off. We'd actually expect the job market to kind of sell off at the same time. So your speculative tech like ARKK, well, that's your technology startups, okay? We're seeing massive amount of layoffs, certainly in comparison over to the last 2 years or so. Now, we're also seeing it in crypto. We saw massive layoffs announcements. Again, that was the second asset, or kind of the major asset that we're looking at here that peaked in value in November. So now they're starting their rounds of layoffs. And now we've obviously seen the internal memos from Elon Musk talking about layoffs inside that company. We've also seen Amazon and Walmart mention on their conference calls that they were actually overstaffed in Q1. And now we're starting to see the layoffs nibbling at the mortgage industry as you have interest rates start to tick up. Consumers are not refining on their homes or maybe purchasing as many homes as years prior. So you're seeing that industry start to lay off people as well. In general, I do not think a higher unemployment rate would be good for stocks in the shorter term. I think this unemployment rate starts to tick up over the next several quarters, maybe even over the next year or two, and that will have a negative impact on stocks. Another reason why I'm not really wild about coming into this market. Now, question number 2 is look, I showed you that tech prices have sold off. Crypto prices have sold off, bond prices have sold off, and obviously assets like Apple stock and the S&P 500 stocks, those have sold off as well. What hasn't sold off? What major asset class, other than maybe energy, but the average person doesn't own barrels of oil. What do they own? They own houses and real estate, and we have not seen a housing crisis yet in terms of the prices of those units go down yet. And will housing follow step with crypto, speculative stocks, bonds, and virtually all other assets out there? Is housing next? And that is a question I think we need to answer before we jump into this market. Now, we do have some anecdotal data. Back in April of 2022, we have overall inventory starting to go up. That has been cited by most real estate experts as the fact that the reason why you have prices continuing to go up, or one of the reasons why you have real estate prices continuing to go up, is the fact that inventory is down. We're starting to see inventory start to stack up. Overall pending sales, again, this data is April 2022, basically last month, compared to April of 2021, the previous year. We're seeing pending sales down by nearly a third, down 32% year over year. You still see two sides, though, to this real estate market. You see median average close price, that actually is up a little bit. You see new listings down a little bit. That contradicts overall inventory somewhat. You also have days on markets going down as well. Not necessarily an indicator of where prices might go, but you have overall closed sales also down 36%. So you have inventory starting to tick up a little bit. You have pending sales and closed sales starting to go down. That could lead to some kind of mortgage or housing price peak and maybe subsequent fall. Now, some other indexes that we'll look at is the US price index. This just got ballooned after 2020. Again, like all the other asset classes that we looked at, from stocks to crypto to Cathie Wood stocks, they all inflated after 2020. And that's what we saw in real estate. It has not declined yet. What was also inflated is this 30-year mortgage rate. Just 6 months ago, this was under 3%. It's basically doubled almost in that short time. There's many experts believing we'll get to a 6 handle on mortgage rates here very soon. Will that spur a lot of homes being sold? I doubt it. We're also seeing U.S. single families sold houses. This is reverting back to more kind of a natural uptrend that you'd expect in single family houses sold. We also have U.S. existing home sales, obviously cratered during the pandemic, but then spiked to elevated levels in the subsequent years. This also pulling back to a more normalized level that we'd expect. Now, it doesn't mean asset prices on the real estate side are going to crash or going to go down. More healthy for that market would be a reversion back to the mean, where housing prices, instead of going up 10, 15, 20% year over year, they go up in the low single digits. That would be the quote soft landing that I would expect in the housing market. But certainly there's a risk out there that all of a sudden the value of people's houses start to tank, like crypto stocks, like bonds, and like the S&P 500. And what will that do to people out there in terms of their attitude and the economy? I think it would be very, very negative. That's another question that I think needs to be answered before you really step in a major way in these markets. Now, question number 3 is, what will the Federal Reserve break? And some of you might be saying, well, look, they've already broken tech stocks. They've already broken Bitcoin. They've clearly broken bonds as well. Obviously, the reason why bonds are going down in value is the fact that the interest rate is going up. And Economics 101 tells you when interest rates go up, bond prices go down. So some people would argue this is one of the markets that the Fed is likely to break. And if you break the bond market, the credit market, well, oh man, lots of more ugly things are going to happen. So there's a leading to people asking this question. And one of the reasons why they're asking this is a lot of research came out today after a Wall Street Journal article that reported that the Fed officials are likely to consider surprising the market with a larger than expected 75 percentage basis point interest rate increase in their meeting this week. So instead of raising 50 basis points, they're going to raise 75. And I'll tell you about this Wall Street Journal author. He's saying this essentially because he is a mouthpiece for the Fed. And I am not insulting this author in the Wall Street Journal at all. That's essentially his role. And it actually, quite frankly, is a key role in markets and Fed communication. The Fed actually communicates with this Wall Street Journal article. They float stuff out here like a 75-point basis hike. So that news has a little bit softer landing later this week if that's the direction the Fed decides to go. Now, what is the Fed actually trying to break? Because they're, by raising a surprise 75 basis points instead of 50 this week, they're trying to break something, and they're trying to break it really quickly. And that is essentially the CPI, or the Consumer Price Index, otherwise known as inflation. Now, here's kind of another way to look at it is it's the inflation that every consumer here in the United States essentially feels. That's the average of utility costs, gasoline, and food at home, and electricity. And any time you've had the CPI of those baskets of goods peak up over 20% year over year, you've had massive declines in the stock market. So that obviously has people concerned that the Fed has maybe a ways to go in order to solve this situation. Now, the other thing that we have to understand is the more that the Fed has to fight this CPI, the more they have to do 75 basis points. Maybe they've got to do 1%, 2% hikes. They got to start doing crazy stuff. Well, guess what happens on the other side? People in general, human beings, are optimistic by nature. And in general, the stock market is also forward-looking as well. Wall Street's still trying to digest the questions that we're talking about right now. What is the Fed going to break? How far will they go? Is housing going to follow suit in this type of thing? And then is there going to be some massive employment? Is there going to be a depression, not just a recession, a depression here in the United States? Wall Street's still trying to digest that. So that's why you see more selling than buying in the markets. But at some point, these questions will start to be answered. And then the expectations will be, well, the Fed is at 4%, 5%, 6%, 8%. Mortgage rates are at 7, 8, 9, 10%. Well, when do they start to reduce? When do you get quantitative easing again? When do you have interest rates coming down, spurring business investment and real estate investment again? That, my friends, is a very, very difficult question to understand, but also take it as a bit of optimism. As you have the Fed hikes this aggressively, at some point, traders and investors start looking to the other side saying, well, they can't do this forever. Eventually, you're going to have easings of financial conditions, and that is when some real easy money is made. Now, question number 4 is, what now? What do you do right now? And this is a question I'm being asked all the time on my Twitter account, on my YouTube comments. People are asking, what am I buying right now? The answer to that question is almost nothing. I'm still waiting for these questions to be answered. And there's no easy or quick solution to a lot of the questions that I had. Now, if you're an older person and you're in or at retirement, well, man, you really need to have a wake-up call. And I I would literally tomorrow go have a discussion with a professional financial advisor that could guide you down the road of a deep recession, maybe even a depression, and how you maintain your wealth. If you're my age, 40 years old and under, well, this is the time to get busy, folks, and don't be fooled by what everybody rotates into. We're going to see a lot of people over the next couple of months rotate into utilities, rotate into consumer staples, rotate into safety healthcare. They're going to rotate out of technology and consumer discretionary. Now, I'm not insinuating on here, don't have utilities a part of your portfolio or any of these quote unquote safer investments like consumer staples, like telcos, like energy, like materials. I am not advising you not to invest in these things. You should have been investing in this stuff already. And if all you had in your portfolio was tech and consumer discretionary, well, you just learned a lesson that when everybody is piling into tech and consumer discretionary, that is when you add to your utilities, your telcos, your energy, materials, and your financial stocks. When everybody starts to rotate into those and rotate out of consumer discretionary and tech, well, guess what's going to be the big gainers after the recession is over and after these 4 questions are answered? Well, it's going to probably be consumer discretionary and technology. Doesn't really matter what you look at in this sector. I've got the XLY here. This is consumer discretionary. This is in a major, we're talking about a major decade-long uptrend. And guess what, folks? This ETF of consumer discretionary, which the last time I looked, I think was primarily Amazon and Tesla, was a large portion of this portfolio. Current price is about 137. If you pull down to the trend line here in the next, say 30 days or so, the downside on this one looks to be about 125. Now, you certainly could break through this longer term uptrend that we've made on this one. It has several times. If you follow this trend line that I have drawn in here, it's broken through there a few times, but we're not talking about months or years of price action underneath this longer term trend line. We're talking about days or weeks. That's why I'd have a close eye on consumer discretionary, because that is what people are rotating out of and into other safety trades. That is a great opportunity when we get these questions answered. The other great opportunity, and quite frankly, I actually bought this ETF today. So full disclosure, I bought some of the IBB. Some of that is the fact that I'm underinvested in biotechnology and healthcare segment. It's a weakness of mine from a single stock perspective. So the way I get exposure to those is through the biotech. I love this technical setup. You've been in a longer term uptrend on this one for over 8 years now. Anytime the IBB ETF has gotten to the bottom of this trend line, it has bounced off it like clockwork. Now, is that to say it will do it again? No, not necessarily. But I tell you what, if you do, you've got strong upside in this one. From the low 100s all the way back up to the 170s, in my opinion, would just be kind of an average move on that security. Another healthcare ETF, the XLV. This one's in a, again, multi-year uptrend. It is farther above it than the biotech sector. That's why I favored buying the IBB before buying the XLV. Quite frankly, the XLV would need to pull back quite a bit more. You're probably looking at another 10% down on this one. Then I would get interested on that. And then we have the XRT, which is retail. This is your Walmart, your Targets, your Dick's Sporting Goods. I would assume a little Amazon sprinkled in as well. Look at this massive sell-off. You're pulling into some massive sideways consolidation on the XRT between about 38 and 51. I would be interested in getting into that as well. And those of you that follow this channel from a regular basis, you're looking to get into Apple as well as it pulls back into some sideways consolidation. Anywhere south of 120, I'd be very interested in adding more shares to Apple. Big shareholder in Amazon as well, as you pull back into this box south of $100 per share, which we're on the doorsteps right now. That is one I would be definitely interested in buying as well. Google is going to be impacted adversely because of the recession. Online ad spending absolutely is going to be reined in over the next couple of months, if not year. That is going to put pressure on Google stock. I think you want to accumulate this in that environment, because the other side is economic expansion. Economic expansion funnels a ton of money. I mean, we're talking about a fortune into online advertising, which Google has essentially a duopoly at the current time. Microsoft, also very steep downward trend as we pull back into this sideways consolidation south of about 230 on this one. I'd be interested in buying that. And then finally, Tesla, much, much higher volatility than most of these stocks, except maybe Amazon. This is pulling into a range that we really like down here, just around $600 per share. Could it break through 600 and go much, much lower? Absolutely. That's why you drip very carefully into Tesla. But in order to have this volatile of stock, you've got to put up with some of this downside risk. In other words, you got to take a little bit of a risk to get some rewards, and certainly your risk reward with Tesla is to the upside at some point. Hopefully you guys enjoyed today's video. Stay calm, relax, laugh a little bit, get to work, get some money coming in the door, simplify your life, sell some things on eBay, get as much money as you possibly can, develop a plan of which stocks, ETFs, bonds, anything that you like that you want to get into, make a plan, find a price target, and start slowly dripping your money into these markets as these questions start being answered about crypto, about real estate, about jobs, about the housing market, and about what the Fed will eventually do after they break the entire financial system. That is when some real good money is going to be made, and we'll be here to hopefully guide you through some of that. Hopefully you guys enjoyed today's video. Back in soon with more. Good luck with your investments.